Adjusting entries within the accounting cycle. The purpose of adjusting entries is to record revenues and expenses that have been earned and incurred respectively, but not recorded. This process relates to the accrual-based accounting method that follows the revenue recognition principle and the matching principle. These state that revenues and expenses are recorded in the period they are earned and incurred respectively. A simple example is wages that are recorded when they are earned regardless of when payday is, or, for expenses, event tickets that are recorded when the event is attended regardless of payment date. Adjusting journal entries is the fourth step in the accounting cycle and occurs at the end of an accounting period after the trial balance is prepared. After adjusting entries are posted, a new adjusted trial balance is prepared to then allow financial statements to be accurately prepared. Adjusting entries can be classified into four different types of entries: deferred revenue, accrued revenue, deferred expense, and accrued expense. Deferred revenue refers to when a company receives cash before it provides a service. Therefore, the liability account increases to record the value of the service to be provided later. When the service is provided, the liability account is adjusted down and the related revenue account is adjusted up to record the value of revenue earned. An exception to the general rule is if money received is credited to the revenue account rather than unearned revenue. This would result in a reverse of the previous entry whereby the revenue earned stays in the revenue account and any revenue unearned, for example, if the service was not completely provided, is adjusted into the unearned revenue account. Accrued revenue refers to when a company earns revenue before it receives cash. For example, the service is provided and payment is made afterwards. The adjusting entry results in both the revenue account and accounts receivable accounts to increase by the amount earned. Deferred expense refers to when a company pays cash before it incurs the related expense. For example, an asset is paid for before it is received by the business. This results in the assets account to increase to record payment of the asset. When the asset is consumed, the asset account is adjusted down and the related expense account is adjusted up by the value of the asset that has been used. Accrued expense refers to when a company incurs an expense before it pays cash. For example, a business receives an asset before paying for it. The resulting adjusting entry requires the expense account and the accounts payable account to increase by the amount paid. To summarize, the purpose of adjusting entries is to record revenues and expenses in the period that they have been earned and incurred. Every adjustment will affect at least one revenue or expense account and one asset or liability account. Adjusting journal entries arise because timing of revenue and expense recognition differs from when cash is exchanged.